Thank you. Again, I'm Laura Pring with Pring and Associates, and I want to congratulate Aaron and the Intercom team on their 25th anniversary. Next up to present is Northern Oil and Gas. Northern is a leading non-operator focused in the Williston Basin, where they have more than 180,000 net mineral acres in the heart of the Bakken and Three Forks oil plays. To tell us more about the Northern Oil and Gas stories, our Executive Vice President of Finance, Mike Kelly.
Well, thanks, Laura, for the introduction that I didn't hear. I'm sure it was wonderful as always. And thanks everybody for dialing in. I am a bit disappointed, I have to admit, that I'm standing here at the home office podium in Minnetonka, Minnesota for this Intercom presentation. I've been attending Intercom since 2006, first as a buy-sider, then the last 9 years as a sell-sider. But this is my debut Intercom Denver appearance on the corporate side. And I really wish we were all together this week in the good old Tabor Center in downtown Denver. But we'll make the most of it though. And really what I intend to do with my presentation is to take you quickly through the pertinent details of Northern, make the investment case, and then we'll proceed into the Q&A. I may have Nick O'Grady and Adam Durlam join me from Northern as well at that point. So I should note that we published a new presentation to our website this morning. I'm mainly going to talk off slides 4 to 6. I may dance around a little bit, but if you want to have a visual in front of you, that's what we're doing. I think I am actually controlling the slides here too. So so you should be able to see my screen, hopefully. I'm going to actually make sure now I am sharing the screen, I believe. I swear I am technically a millennial, but here we go. All right, so we're good. Cool. Slides are working. Let's go. Now let's just jump into who we are. We're gonna frame this up here. Northern is a 183,000 acre pure play Bakken company. We're the highest rate of return on capital company that you will be face to face with here at the conference today. Company is also a free cash flow machine. We're going to do over 100 million of free cash flow this year, and more than that in 2021 as well. We're protected with very attractive hedges through 21 at prices ranging between $54 to $58 a barrel. We also possess a very healthy balance sheet. We're at 2.4 times right now in terms of our leverage metric. And looking forward, I'll just tell you that we are very excited about where we sit today. Despite activity levels dropping off a cliff across the 48, Northern is currently staring down some of the most compelling investment opportunities in our history. And we've put ourselves in a great position to be able to capitalize on these deals. Now, let me give you the 10-second history on Northern here. We've basically been in the Bakken since day one of the unconventional era. In fact, we have participated in over 6,500 wells, which is more than 40% of the wells ever drilled across the Williston Basin. Our internal database that captures these results is a real competitive advantage of ours, which we'll talk more about in a bit. Furthermore, our Bakken inventory is really rock solid as well. If you flip quickly to slide 10, I'll do that for you. You can see that we are levered to the right counties, which is McKenzie, Montreal, Williams, and Dunn. These are rightfully considered the core of the core, or as our COO, Adam Durlam, likes to say, the double bullseye up the basin. Now, let's go back and talk on our business model, because it is unique. We are the largest publicly traded non-op working interest E&P company, and we're damn proud of it. You may ask why, and the reason is really just look at the results. Our business generates, like I said, and like I opened with, the highest return on capital employed in the oily E&P space. Put together this slide in one of our recent presentations that shows you we're kind of the top of the heap of the oily E&Ps in 2019. We had our ROCE at 16.4%. And I want to dive into that a little bit, because I mean, to me, being a former, Wall Street type guy, an investor in the sell side analyst, the ROCE is probably the best metric I think you could look at to assess the health of an E&P company. Are you truly a decent company generating good returns. And this is where I turned, and one of the reasons I was very, very attracted to Northern to come work here. So let's talk about the major drivers. Number one, we are a lean machine. Northern has only 24 full-time employees. On a barrel of oil basis, we have the lowest cost unit G&A in the space. A little anecdote, I was catching up with a buddy this weekend, and he asked me about a new gig here at Northern, and I about made his head explode when I told him, yeah, we're only 24 employees at the company, and we should be able to do 500 million plus of EBITDA with that sort of headcount, and that just that was unfathomable to him. More to this point, if you look again at slide 6 here, we have on the lower portion of the page, this shows that we've added this new G&A efficiency metric to the deck, and it shows annual G&A dollars spent per well drilled. You can see that the average E&P company is going to spend over $1 million per well drilled. That's not us, though. We're half of that number, and that is critical to posting, such stellar return on capital metrics. Another major driver is that, let's just be frank here. We are not your operated E&P that's tethered to 100,000 net acres that everybody and their mom knows is really tier 2 at best. Yet, because they're now pot committed with this acreage position, they keep banging their heads against a wall, trying to make it work, despite incinerating, endless amounts of capital across along the way. That's not us. We have plenty of options, and to that point, we work with 46 different operators across our acreage position. We've got a diverse set of over 771 future drilling locations ahead of us. Page 15, if you flip to that real quick, you can see that this gives us the granular detail. If you want to geek out in terms of who is the operator across a good chunk of this undeveloped acreage, and then what reservoir we are levered to, which is the primary of the 771 is the middle pocket. So I do point that out. But even more important, and I did allude to this earlier on, is that we've been involved in 40% of all the wells drilled in the Bakken. Our data set is a huge advantage to us. We've built over 300 proprietary type curves covering the basin. We've captured actual cost data by operator, and almost on a daily basis, we're going to force rank returns by operator, by area. So we've got a great sense when we put money to work, what sort of return should actually come back to us. One more, to that point, again, let's look at page 12 real quick. Flip into this. This shows you that we've had a steady improvement in our well productivity since 2015, and this is a testament to our data advantage really at work here. All right, one more element of the high return on capital advantage. This is another new slide that we've put in the deck here, and this is something that is unique to Northern, and this is our ground game success that we've had. We are routinely shopped working interest in very compelling drilling opportunities that are either already in process or about to commence, and that's what we call our ground game. We've engaged in over 200 of these deals since 2018, and they are extremely lucrative. Many times, we are the beneficiary of operators simply needing to shed their ownership in projects they don't operate, despite possessing no-brainer economics. This is especially the case now as capital has become scarce in the industry, and investors, it's now non-negotiable for investors. You have to be free cash flow positive at the corporate level. So reducing CapEx has become paramount. We've seen several instances where companies have a very broad corporate mandate to limit their non-op spending in an effort to reduce that overall CapEx. Thus, they've sold us non-op working interest at attractive prices in projects where we know the returns are better in those non-op opportunities than what they've got going on their own operated acreage. This makes really zero economic sense, but hey, it's 2020, and I'm not surprised at anything anymore. So we put, again, this page, slide 7 shows this slide dedicated to the ground game. And the takeaway is that despite a year where activity has, again, reduced massively, kind of coming to a crawl across the industry, especially over the Bakken, our actively managed ground game strategy has been busier than ever. We have thus to date inked over 6 net wells set to come online in 2021 in the core of the Williston Basin. And we've laid out, we really wanted to show you how these deals in aggregate have looked. We've laid out the capital inflows, outflows in these deals on the slide. And what should be your takeaway is that we have a sub 3-year payback period on these investments. And you should also see that the return on capital employed is massively accretive in the upcoming years at the corporate level. And for your Bakken connoisseurs, you can see, we put the map on here as well, that this really is in the core of the basin. All right, so as we do these deals, we also look to lock in returns through hedging. Risk mitigation is at the core of our DNA. I think we've got the next slide that shows this. The real takeaway here is that in 2020 and 21, we've got the majority of our production hedged, $58 and above for the remainder of 2020. In 2021, we're inching up toward $55 per barrel. So great locked in prices. That has allowed us to be aggressive with the ground game this year, and also to pay down debt, which if you listen to any of our conference calls, you know is extremely important to us. We've stressed our devotion to paying down debt, especially our highest cost, 8.5% second lien notes. We've taken down this piece of paper, you can see in this on slide 9 here, by $120 million year to date. That issue now stands at under $300 million. And in Q2 as well, we took down the bank revolver by $20 million as well, roughly $20 million as well in the second quarter. So the ultimate goal looking out to the future, we stand at 2.4 times net debt to EBITDA right now. We want to get that closer to 1 times, and we're going to continue to chip away at that with the free cash flow we see coming second half of this year and into 2021 and beyond. All right, I want to hop back to page 4 real quick. One other aspect of the story that I think needs to be told, it's on our ownership structure and management incentives. Northern is 30% owned by the board and management. And management's bonus compensation over the last 2 years has been paid 100% in equity. Our base salaries, I hate to say it, but are some of the lowest in the industry on a cash basis. But the net of all that is the executives here, and this is the way it really should be. We are extremely incentivized and motivated to do what's right for the long-term health of the company and for the shareholders, because we are those shareholders. So let's flip to page 5, just one more slide ahead here, and let's recap this before we go into the Q&A. Let's talk about the NOG investment proposition. So let's summarize it. First and foremost, superior returns and free cash flow. 16.4% return on capital employed in 2019. We were in double digits for the first half of this year, despite a tough environment as well. Leading industry free cash flow, over $100 million this year, more coming in 2021 as well. Let's talk about the superior data set and capital allocation. We've been involved in 40% of every Bakken well drilled. So when we make decisions, it is backed by solid data. Also, right now, our organic and A&D upside is tangible. Our A&D machine is working in overdrive right now, despite depressed activity in the industry. And I think that is unique to our business in an industry downturn here, that ground game component doesn't die. In fact, it's actually accelerated this year. Hedges, another great thing about the company here over the next 2 years. We are significantly hedged. We'll be over essentially 100% hedged for the remainder of this year, and vast majority of next year hedged as well. And finally, valuation. If you look at it, this is the final slide here. We are standing at today a 30% free cash flow yield. We trade at 4.4 times EV to consensus EBITDA, which is a healthy discount to the group. And if you flash back, you look at 2019. You're kind of in a mid-50s environment. Activity we weren't curtailed across the board here. And so in 2019, if you look at the price we're trading at right now, we only trade at 2.7 times our 2019 earnings. So a 2.77 times PE ratio, that to me, being an old value guy, it screams compelling valuation. So with that, we are excited about what we've got going forward here, the opportunities to continue to invest during this downturn and in deals that are accretive on an already very, very high, elevated, best-in-class return on capital in the E&P space. So I'll kick it over back to Aaron to see if we got anything in the hopper for the Q&A. Thank you.
Hey, Mike, thank you for that presentation. And again, thanks for being here. I wish, like you mentioned in your opening comments, that we were all sitting around the Westin and going to enjoy happy hour this afternoon. But again, appreciate you being here. So I'll start off the question that we have here. Talk to me about your plans for free cash flow and where does that incremental dollar go as you guys are building cash?
Yeah, so we had it laid out when we came into the year. We thought we were going to be in kind of a mid-50s environment. The ultimate goal there, we call it the 1/3 doctrine, where we had a third that was going to be allocated to debt pay down, a third that was going to be allocated to kind of acquisition opportunities above and beyond our base CapEx program. Then a third was going to go to a dividend for the common equity. So we decided to punt on issuing a dividend for the time being and really focus on the balance sheet. We have, as I mentioned, over $120 million taken out of the second lien note this year. We focused on that. And so I think we're going to be, until we kind of creep over kind of a $50 world, would be more compelled to focus on the balance sheet and then to focus on these ground game deals that, where we see 3-year payback periods or less at the current strip price.
And so here's another one. Talk to us a little bit about your current base decline rates. And then a follow-on second question would be, what kind of planning do you guys have going in and around the Dakota Access Pipeline? Yeah,
sure. So base decline, we ended the year, we were kind of mid-30s, 35, 36%. It's a little harder to gauge right now as these curtailments are coming back online. But I think we get that question a couple of times today by investors, and our answer is, certainly as we get to the end of 2020, we think it would be, at that 35% or lower type number. As it pertains to DAPL, I mean, this is obviously a huge development that we're keeping track of here. Let's paint it first. We do think cooler heads will prevail. We're very pleased to see the appellate court grant the stay a week or so ago. So we think that's going in the right direction. Hopefully we could have the environmental impact statement kind of fast-tracked and completed before January. So just in case you ultimately transition the executive branch, that's not going to be at limbo. So that's kind of the way we think it should go. So hopefully it's much to do about nothing, but let's just paint it the worst case scenario. Things get delayed. All of a sudden you've got a Biden presidency. You want the EIS is now in the hands of different administration with different environmental motives, and it just gets hung up. So I think what we have told people is, go back to 2017. There was a time before DAPL here, and where we were running 800,000 barrels a day on rail out of the basin. So, worst case scenario, that can happen again. Obviously, it's not ideal, but the crude consultants that we talk with say, all right, long term, that probably adds $2 to $3 onto your diffs. Again, hopefully it doesn't come to that, but hardly a basin killer, even under the worst case scenario.
Well, let's come back to your ground game that you highlighted and you talked about. Tell us a little bit about how you guys are looking at deals and what are the criteria you're looking for. You mentioned a lot of deals. I'm assuming you're not taking every single one that comes your way.
No, and you could see it that wells that had been proposed to us, I think we can sense that it was kind of a record, or if not a record this quarter, one of the lowest on record in terms of us, kind of stiff arming operators in the end of toward the first quarter, saying thanks but no thanks, and that also is something that is highlights the flexibility of our business model as well. We don't have we're 24 guys here in Minnetonka, Minnesota that are making investment decisions really at real time, and we don't have 3 crews that we've got long-term contracts on that you're going to have to be part of your decision if you're an operator and have some kind of long-term fixed components to your business. So that's, to us, we were able to react and say thanks but no thanks. And Adam Durlam's going to join us as well. You want to squeeze in next to me? Here, Adam. Sorry. Our COO, so you get, you're bringing the heat there, Aaron. So I sent him a text message, said, get in here, Adam. But yeah, we're talking about just the kind of, maybe the investment hurdles for the ground game.
Sure.
And yeah, Aaron, anything else you wanted to get at specifically on that?
No, I think just the investment hurdles and certainly, I think you guys have spoken a little bit about in the past how selective you guys are and making sure that it's a good fit for what you guys are actually trying to achieve.
Sure. You want to take that?
Yeah, so from a ground game standpoint, as well as just organic AFEs, we're taking a look at, who the operator is, running a handful of different sensitivities, what's the overall risk profile, completion methodology, all of that, and seeing kind of, do we have asymmetric upside? Do we have, maybe a little bit more downside risk, and really taking a scrub at everything in that regard. And so what we've seen is a retreat to the core with the 11 rigs in the basin right now. And what that's meant is that these operators that are electing to drill wells and are drilling some of the best wells in the basin as it stands right now. And so the overall level of the quality of the opportunities is probably as good as it's ever been. And then couple that with kind of capital availability and the constraint there. A lot of the operators that have non-operated working interest in AFE proposals have a mandate, whether they're distressed or healthy, that they cannot elect to invest in any of these kind of non-operated assets. And so you have these chunkier working interests that have a 30-day kind of timeline in order to elect to invest in these things. And so you've got all these different constraints going on that effectively limits the buyer universe of all this. And so when you couple all of that together as kind of bring home to the hurdle rates, it's got to meet or exceed anything that we're electing to organically. And then from there, it needs to be complementary to that. So you're looking at, IRRs that are in sometimes inclusive of the overall acquisition cost north of 30-35%. And it's going to depend kind of where we're at and depend on the sensitivities that we're running from a price tech standpoint as well. And same can be said with kind of the DAPL, lawsuit right now. We've got to underwrite things as if, worst case scenario, DAPL is never turned on or is turned off and is never turned on again. And so you'll see us, create certain types of earn-out provisions or those types of things as we structure agreements and whatnot to make sure that we're locking in the appropriate rate of return.
That's helpful. So kind of the next question, and you touched upon it a little bit in your answer, is there in and around the activity level in the Bakken. You guys certainly have your pulse across the entire play. You mentioned 11 rigs working, and there's been some commentary throughout the conference of maybe some drilled uncompleted wells or some of that completion activity coming back. Do you guys have a sense on that for where you guys are positioned in the Bakken?
Yeah, I mean, the answer is it's relatively fluid. The conversations that we're having with our operators seems to be that a lot of the DUCs are scheduled kind of towards the back end of the year and into kind of early 2021. That being said, you know, we're following up with our operators on a day in and day out basis, and they're changing kind of their tune, you know, based on the current situation. So relatively fluid in that regard. I don't know, anything else you want to?
No, I mean, you know, to Adam's point, I mean, I just wanted to point out again that, you know, we're going to exit the year with over 30 DUCs, which we are excited on how that tees us up for 2021. A lot of that money's already been spent. There's been, what do we call them? The CDs.
Completed but delayed.
Yeah. Completed but delayed. So we're kind of coming up to probably what will be the most capital efficient year in our history. And, you know, to the free cash flow question earlier, that's what gives us a just great deal of visibility, you know, with the hedges, with those CDs, the wells in process being over 30, kind of record levels, we're pretty damn close, record levels of work in process. It is really setting us up for a strong year.
Perfect. Got one here talking about more to your balance sheet. What is your appetite for converting more of your debt, either to equity or reducing debt as you think about your prospect for free cash flow?
Yeah, and so you kind of asked about it earlier, Aaron, in terms of just the priorities of the free cash flow. And we do have a $65 million note that is coming due in January of 21, which yeah, we're just wanting to make sure that we've got the capacity to just pay that off in full, and that's the plan right now. Again, it's a small little nugget. We want to take that out. That should kind of again speak to the devotion to knocking down debt, but specifically to these exchanges which we've done, where we could get debt, you know, taken out, converted to equity, and do it at a discount to the face value, the par value of that debt. We're going to continue to kind of evaluate those on a one-off standpoint, and I think we still are. If the debt's traded at a discount from a risk standpoint, we really want to whittle away at that 2023 issue. So I'd expect more of that from us.
That's helpful. And so here's a question on if there's mineral interest inside of your asset base that can be monetized through direct sale or via maybe a public offering or something like that.
I mean, there's always an option, I guess, to carve out, you know, certain overrides and those types of things. Generally hesitant to kind of go that route. I think our CEO, his viewpoint on that is that, you know, when you start selling down overrides like that, it's a perpetuity debt. And the other thing that I think about just from an operations standpoint is, you know, what does that mean to the underlying leasehold, and what does that mean to the viability of the economics of where we are from an NRI standpoint. So I think there's a handful of different options that we can kind of take a look at there, but it's something that can certainly get precarious should you be in a lower for longer price environment where you had a, you know, 87.5% NRI and the wells are economic at that point. Then you carve off, you know, 7-8%, you know, overriding royalty in that regard, and now you're at a 79% and the wells don't necessarily pencil. So it's all very unique and specific to certain areas where we have different, you know, royalty net revenue interest, excuse me.
Yeah, Aaron, and if Nick was if you heard your mineral question, he's gonna be running in here in a second to give you his spiel on it, which is a good one. But I think he's on. We actually have our shareholder vote right now to approve our reverse stock split, which should be getting done right now. So we can look forward to hopefully, you know, either an 8-to-1 or a 10-to-1 stock split. So that is ongoing. But Nick, is rightfully gets a little bit excited when the question comparison with minerals comes up, and as everyone here on our executive team, where Adam can tell you he's looked at, he's done 200 of these ground game deals over the last couple of years, and he looked at countless mineral deals too. And so we're pretty damn close to a minerals company. The only difference is a mineral company pays a lot upfront for that acreage, and doesn't pay anything in terms of the CapEx outlay. But pretty similar risk parameters, if you think of it, where we're the opposite. Very little upfront cost for us. Then we pay our largest cost is going to come with the AFE of the well. So we'll pay our proportionate working interest. We see it's despite some little subtleties and differences there, the returns that you get right now of a working interest ownership relative to a mineral ownership, it is kind of a no-brainer. The higher returns are working interest to us. We're indifferent. We'll go to where the returns are, and right now we're just not seeing it come close to being competitive on the mineral side versus the non-op side.
Yeah, I mean, we've got a couple deals in process with minerals right now, but to Mike's point, you're underwriting a non-operated asset the same way. The mineral space is significantly more crowded than the working interest one, and we're seeing significantly better opportunities.
Perfect. So we got probably time for one more question, and I wanted to circle back to your hedges. Mike, you had mentioned that hedges were obviously a very important component of your strategy going forward. I think you mentioned your hedge position, but you think about going into next year and maybe in this lower for longer type time frame. Talk to us a little bit about how you think about hedging and that strategy going forward.
Yeah, we're not going to sit here and play oil economist. That's not our MO. What we do want to do though is make sure that we are taking risk off the table to the highest extent possible, and where it makes the most sense. I think the best kind of example of that is we've been very active on the ground game here. We showed that slide when spent some time with that. We've gone out now into 2022, and we've put on, I think, 1,000 barrels a day here in Q3 at around $50 in terms of locking in oil prices, because we know that works with what we've just underwrote in terms of the ground game deals. So that's really in the back of our head. You start getting above 50, that seems reasonable to us, and enough to lock in a pretty attractive profit. The 50 is kind of that point of demarcation. Our business started looking very good, very profitable at that $50 or above mark.
We'll leave it there, and we look forward to many more days above 50. Gentlemen, thank you very much for joining us, and we look forward to being in person next year here in Denver.
That's right. All right, Aaron. Thanks, man. Appreciate the invite. Take care.